Season's greetings, everyone. As always, Ryan Callahan here with Northeast Planning Associates. This month's question is regarding annuities held within an individual retirement account, also known as an IRA. Annuities have a reputation of being very complex products, and so can IRAs, especially when it comes time for required minimum distributions, also known as RMDs. You put those two together, you can find yourself in a whirlwind of confusion. Here's what you need to know if you hold an annuity in an IRA. First, let's discuss RMDs. In retirement accounts, the government is giving you the benefit of deferring your taxes, but after a while, the government needs to start recouping some of those taxes. As an example, let's say you create an IRA at 30 years old. Well, the government is going to give you 40 years worth of tax deferral before starting at age 70 and a half. Then the government will begin to start forcing you to take money out of those accounts, regardless if you need the money or not. More often than not, you figure your RMD by dividing the balance of the IRA as of December 31st of the previous year by a factor based on your age. But if your IRA holds an annuity, you may or may not have to include its value when figuring your RMD. Generally, there are two kinds of living benefits out there. One is called a GMIB, and the other one is called a GMWB, Guaranteed Minimum Income Benefit versus Guaranteed Minimum Withdrawal Benefit. There's a massive difference between the two. GMIBs are annuitized, whereas GMWBs are not. Annuitized is defined as the process of converting an investment into a series of lifetime income payments. Now let's talk about this for a second here. Okay, everyone, so here we have two separate IRAs. We have one valued at $500,000 here and the other one $500,000 here, and both owners decide to buy annuities, but there's a big difference. This owner decides to buy an annuity that is a GMIB, once again a guaranteed minimum income benefit, which per the IRS, once that is turned on, it is considered annuitized. Now the annuity payment annually is 5% per year, which means that this client will always have 5% of the $200,000 coming in, even if this $200,000 is fully withdrawn over X amount of years. Same scenario here, this person bought an annuity as well, except it's a GMWB. It is a withdrawal benefit. They will also get 5% for the rest of their life, except the contract will not be annuitized like this one here until this $200,000 goes away, and then per the IRS, it is considered annuitized. The remaining $300,000 are in, I put NA here, non-annuity assets, okay? Let's look at the difference. So once again, at 70 and a half, the government is going to force these individuals to take out required minimum distributions. Well, the first RMD per a lifetime table has to be 3.65% at 70 and a half. Well, $10,000 is coming out of this annuity, but unfortunately, because it's annuitized, this part of the benefit does not count towards the non-annuity RMD. So 3.65% of $300,000 is $10,950. You add these two together, the taxable income coming out of this IRA will be over $20,000. It'll be around $20,950. Here's the difference here. Because this $10,000 is not annuitized, it will cover part of the withdrawal from the non-annuity asset. So we have to reverse engineer this side. 3.65% of $500,000 is $18,250. Well, with $10,000 coming out here, now they only have to take out $8,250 to meet the IRS requirements. It's a huge difference because as you continue to go on through retirement, your RMDs are going to increase. And this year it's 3.77. So now instead of the $10,950, this bumps up to $11,310. Still have the annuity coming in, so now the total income is over $21,000. Here, yes, your RMD increases from $18,250 to $18,850, but still, look at the difference. This person only has to take out $8,850 out of their non-annuity asset, where this one had to take out the $11,310. So when we add up these years, you'll see here a big difference. What's coming out of the IRA, let's first look at that. Over 3 years, this person, and we used a very simple example here, we just kept working off of the $300,000. We're not taking into account market fluctuations or anything like that. We're trying to keep it simple for conceptual purposes. They would have had to take out almost $34,000 out of this account. That's over 10% over 3 years. Whereas this individual would have had to take out less than $27,000 which is, of course, less than 10% of the IRA asset. Also, if you add into account, because there is income coming from these annuities, in this column here, this is showing you the taxable income over 3 years. Well, this person took out almost $64,000, whereas this one took out less than $57,000. That's a difference of $7,340 in taxable income. So I know what you're saying. Why would anybody ever buy a GMIB? Well, the fact of the matter is, folks, is the industry has really changed. GMIBs are not as popular anymore. GMWBs are much more popular, one, because of this. But still today, you may find GMIBs that actually have higher guaranteed distribution rates than a GMWB. But that doesn't happen all the time. So this is a very simple example, though, on how you need to know what you own in your IRA. And if you have an annuity, do you know if it's a GMIB or if it's a GMWB? What are the implications? And then also, how does it get affected when we start talking about RMDs? So the main question, folks, is it annuitized? We do a lot of reviews for our clients who currently hold annuities. Some who have owned annuities for over 10 years. And they want to learn more about this. What are their benefits? They forget because the contract was issued so long ago. Are there alternatives? And how does it affect my RMDs? We can help you answer those questions. Feel free to contact us if you would like us to do an annuity review for you. But as always, regarding the question of the month, keep those questions coming. We've had some great ones for 2019. We're really looking forward to the questions for 2020. And as always, you can contact us at 833-CAL-PLAN. That's 833-225-7526. Or visit our website, www.callahanplans.com. Happy New Year, everyone. Happy holidays. We'll see you next year. Take care.